Hi, this is Alexander Nikolov from trendrecognition.com. I prepared a short video presentation for you that discusses the short-term outlook for the US stock market, and we are going to have a look at some key market industries and some other risk-averse assets to see if the current strong decline from the August top is something that one should consider as a more serious decline or just a temporary pullback within a bull market. So let's start with the short-term outlook of the S&P 500. Right now, after hitting the 1040 level earlier today, the market is rallying a bit, but this rally is probably just an oversold rally that is sharp, but probably short-lived. So let's take a look at the bigger picture on the daily chart. You can see clearly on the daily chart the trend is on the downside. This blue line is the 100-day moving average, and as you know, in our trend definition, we use the main factor to describe market trend is to see where is the price in relation to its 100-day moving average. Here the price is clearly below 100-day moving average, which acted as a resistance in June and then in July and August, more or less. And the moving average itself is trending down, so the trend on the daily chart of the S&P 500 is on the downside. And as you know from our short-term analysis, we expect the market to make a full retest on the July low and also to post a lower low, most likely in the 984 area before bouncing back for several months then. So the short-term trend from April stop is on the downside, and from what we are going to see in the trend in the risk-averse assets, and also from the trend of the key industries within the US stock market, you can see that right now the US stock market is very weak internally, which suggests that the current sell-off and the larger degree decline that started from April stop is likely to continue for much more time than most people consider. Let's take a look at some risk-averse assets. First, the US Treasury bonds, the TLT ETF. You can see here that this ETF broke on the upside in late April, early May, and is in a clear uptrend well above its 100-day moving average. So the trend in US Treasury bonds is on the upside. The trend in dollar-yen rate is down, which means the yen is appreciating. The trend for Japanese yen is on the upside. So this is again a risk-averse asset that is trending in the opposite direction of the US stock market, which is a bearish sign for the US stock market. Let's take a look very briefly at the trend of some key market industries. Let's start with financials. This is the XLF ETF, the financials ETF, financial stocks. You can see here that it's not in a clear bear market, but the 100-day moving average, which is the red line, acted as a strong resistance in May, then in June, then in July and early August, and you can see that the price is well below its 100-day moving average. So the trend here is sideways, but with a negative bias. Once this 1350 level breaks firmly on the downside, the trend will be considered a strong downtrend. The energy sector, XLE ETF, here the trend is again sideways or slightly down. As you can see, the price is well below and have stayed for many months below its 100-day moving average. Currently, it's below 100-day moving average, and the moving average itself is trending down, so the trend in the energy stocks is also down. Consumer discretionary sector, you see again the trend is down. Again, the 100-day moving average, the red line, acted as strong resistance during this rally from the early July lows. You see in late July and early August, the rally was repelled by this 100-day moving average, and now the price is clearly well below this long-term moving average. So here the picture is again negative. It can be positive if the market breaks above its August and above its June tops. But until that happens, the trend is on the downside. The next sector, retail holders, retail stocks. You see here a very well-defined downtrend. Prices are clearly well below the 100-day moving averages. This sector is actually lagging. It's weaker than the broader market, so it's in a strong downtrend. Metal and mining stocks, sideways trend, but prices again below 100-day moving average, which means the bias and the risk is on the downside. Once this sector breaks below this support level connecting February and June lows, the picture will become much more negative. Semiconductors, again sideways market, but right at the support level with high risk of breaking down. So this is not a healthy sign for the broader market. Biotech stocks, again in downtrend, well-established downtrend. Price is clearly below 100-day moving average, which again acted as resistance in early August when the market topped out after its a month or so rally that developed from early July's low. Of course, there are some sectors that are holding up. One of them is utilities. This sector you see, the XLU ETF is above its 100-day moving average, so it's in an uptrend. So this is one sector that one can consider positive. And of course, the gold stocks are holding quite well right now. But you see here the danger and the risk is greater again on the downside, because the prices are very close to this this uptrend line here, and once the market breaks below this trend line, it is very likely that gold stocks will crash. So I will be bullish on gold stocks only if they manage to break above the ETF. GDX ETF manages to break above the 55 level. So in conclusion, the S&P 500 index is in a short-term bear trend, which should be respected until there are signs that it is over. Also, the risk-averse assets, the TLT ETF, these are the US Treasury bonds, and Japanese yen are in uptrends. So this is again a warning sign for the broader stock market. And most of the market sectors are in downtrend, in bear market. So that means that the US stock market is internally weak. And if a bull market is to start, then we should expect some consolidation first, during which the market will become a bit stronger, and only after that a new bull market can start. In conclusion, again, we are in a bear trend, and we should respect it until there are signs it is over. Thanks for watching and listening, and I'll be talking to you in a week or two.